It has been a while. I apologize for the delay. I just my workload tripled, in the last month and a half here, so it's been a little crazy. But I have been checking in from time to time, hearing these deal stories, which are great. And I've been rolling this out to a couple of different people, and they did have a couple questions. The one benefit that I really like from this is that you can buy that investment horizon timeline. If you kind of got to the game late, the ability to offset those capital gains, defer them, gives you that time to really catch up with those investment dollars, which I really like. But a couple of questions that came up. One guy is selling a home down in San Diego. The other one is selling a business. But they had asked that, and they're in California, so they had asked that if they set up the trust, and it's a 10-year agreement, if they move within that 10 years to a different state, are they still beholden to those California taxes? And so,
it's a great question. I'll let Jake take that one because I was talking a lot. Jake, what do you think?
Let's just speak to nexus. When I say speak to nexus, nexus is kind of a tax term. It talks about the origin of where tax should have or would have been incurred, or at least attached. And so if the properties, let's say, are in California, and there's a sale of that in California, even though it's being absorbed by the trust, California is going to maintain some stickiness because it was originally an asset located physically, tangibly in the state. And even though we're deferring everything, at some point in time, if that's all being tracked, now here's your other obstacle, so to speak. If that's all being tracked, because say that you sell a home in California, you invest in a business in Texas, then you sell that business in Texas, you invest in, I don't know, the casinos in Las Vegas, what have you. So you've got this stream of things going, and how far will the state actually track you? Well, I'll just attest that the state of California will track you as far as they possibly can.
Absolutely.
And they will always want, should you actually make a distribution of that principal, they'll always want that portion that is owed to them.
Yeah.
If it's a different kind of asset, though, like intellectual property, digital rights, things of that nature, then California doesn't have as big of a claim to the stickiness of that asset. And even though there might have been a transfer of that asset during the time that you had domicile or residence in California, it's not a California asset necessarily, it's a digital asset. So there's some things there that you need to properly prepare yourself with, you and your legal counsel, your tax counsel, everybody else, so that should you decide that, hey, I'm going to do the deferred sales trust, I'm going to grow things really big, then I'm going to move to Puerto Rico, and I want to only have to pay Puerto Rico taxes and stuff when I take it out of the trust. There's more than just using the trust that you need to do to prepare for something like that.
So yeah. So the short answer is yes, California. Because think about it, you could imagine you were Steve Jobs and you started out Apple, right? And you're like, okay, this thing's worth $1 trillion. I'm going to sell it to the trust, move to Puerto Rico, and then I'm just going to take the proceeds, right, and slowly drain it out. So yeah, where it's at, it's going to stick. And there might be some nuances there with intellectual property, like Jake was saying, but basically, yeah, what is owed to California, but it's only triggered when you dip into the principal. So if you sell a $10 million primary home in La Jolla, San Diego, and the tax would have been $3 million. If you just keep that 10 million in the trust and you live off the interest payments, and if you're in the state of California, you'll pay ordinary income tax in that state of California, but they say you move to Texas and you keep the same interest payments. Well, California doesn't have any access to those interest payments because you're no longer in the state of California because that's ordinary income. But should you dip into that principal, that 10 million, yeah, that percentage, let's say 33 to 37% in California, depending if it's an investment property or primary, is going to be triggered, right? So you can't have your cake and eat it too here. That would be, right, that would be incredible, but California's owed what they're owed. Jake, do you want to add anything else to that?
Any strategies that you might hear about in changing nexus are difficult. There are some things that can be done. Just as Brett and I are really good at helping people know and understand when it is appropriate to use a deferred sales trust, we can also help people understand various strategies on how to get out of one too, right? But changing nexus is a highly contested thing that some people have won and some people have lost to the IRS. And it's definitely a much longer, detailed conversation to have.
So with stock, both public or private, would that change the scenario at all?
If it were stock, marketable security type stock, not private security, that would almost be considered a digital asset, yes. So that would be a little bit easier to change nexus on liquidating something like that. Now, if it's private security in a private business in the state that you currently reside in, that would be a little bit more on the more difficult side.
Okay, great. And then the other question that they had was these 10-year agreements. Are they just set up in perpetuity, or is there like 1, 2, 3, and then?
Yeah. Yeah. So they're 10-year terms, and every 10 years you can renew for 10 years and renew for 10 years. So 9 years, 6 months, you have the option to renew for basically 10 years. You can also renew them year 5 or year 3, but we don't go longer than 10 because we want to be what's called commercially reasonable, Jim, right? Like
Sure.
if you or I were to do a seller carryback for one another, we're probably not going to do a 100-year term, probably not going to do a 30. We probably do a 10, right? But
Right.
doesn't mean we can't renew it at the end of the 10-year term if everything is going well. And that's you could also make it a 5-year term or a 3-year term to start. But at 9 years, 6 months, we're calling you, CPA's calling you, Jake's calling you. We're all calling to say, hey, do you want to renew, Jim? Because if not, the balloon payment's coming due and all the tax is going to be triggered. Gotcha. And so we're making sure to keep that on. I do want to mention one other thing too. There's ways to partner with the trust to buy investment real estate. And there's a thing called cost segregation or bonus depreciation that could incur loss on a brand new depreciation schedule if you're an active owner, investor, GP with the trust. In that new asset, you can get up to 80% of that depreciation. That could then offset cash flow and potentially even offset cap gains tax. So there's some creative ways to think about that. We'd want to check with your CPA, check with the DST tax attorneys on those details, and every single circumstance is a little bit different. But that might be a creative solution, Jim, to the person who's moving out of state if they want to become an active GP in partnership with the trust to establish a new depreciation schedule, accelerate that, and then potentially draw on the trust and on the offset loss in a given year. Does that make sense, Jim?
No, I love it. And that's why I like Shay's story too. I mean, hopefully he'll put on a clinic or a webinar for that. That's I like how he pulled that off. And then the asset under management fee, does that go up when you go into real estate, passive syndications, things like that?
Good question. What are the fees? The fees are generally about 1.5% to 2% recurring, no matter how and where the funds are invested. So let's just take $1 million, for example. Okay. No matter how it's invested, if it was all into real estate, although we got to keep liquidity, so we can't actually do that. But if it were hypothetically, it'd be about 1.5% to 2%, depending on the deal, depending on if it, where it's located in the investments. If we're 100% in securities, it's about 1.5% to 2%. In other words, you're never double charged. The actual equity in the value of the trust is what is charged, and it's always about 1.5% to 2%. That could vary a little bit depending if there's something a little more exotic that the investor and Jake as the financial advisor is going into. And so, but those are the fees. That makes sense, Jim?
Yeah, absolutely. And I shared it with them that I think it was 1.5% upfront for the lifetime legal protection, audit protection.
That is a one-time fee up front, which is separate from the recurring fee. So if let's say it was $1 million deal, it'd be about $15,000, right? If it were like a $3 million deal, it'd be $15,000 on the first million, and then it'd be 1.25% on that additional $2. That's a one-time legal fee that covers lifetime audit defense and the legal structure. And then Jake Miller and myself are basically 1.5% to 2% on the net proceeds into the trust. So let's say they had $1 million debt on a $3 million sale. So on that $2 million, we're charging about 1.5% to 2% on a recurring basis.
Okay. And then the last thing I had was I had shared with him that there is a 2.0, DST 2.0, and I wasn't quite sure what activated that or what basically that.
So Pierce, so let Pierce jump in. He hasn't talked in a little while. Pierce, talk about the DST Plus. Why would someone use it? And the DST 2.0, what is it all about?
Yeah. So what's unique about the DST 2.0 is that there's like a $5 million threshold. After you get past that threshold, and maybe Jake can speak a little bit more into how this exactly works. But from what I understand, there's an interest payment that starts accruing for essentially the loan that you're getting from the government by not paying the tax. And so what ends up happening is that you start accruing this interest payment. And so the DST 2.0 is a little bit of a different mechanism that we're using to not only eliminate that interest payment, but also able to move assets outside of the taxable estate.
You nailed it, Pierce. Right. I could have said it better. So essentially it depends on your circumstance, right? So Jim, your client or you show up with a circumstance, and one of the first questions we're going to ask is, what's your total net worth? Right. And they're going to say, it's 52 million, right? And let's just an example. Okay. Of that 52 million, how much is inside your taxable estate? And they're like, all of it. Okay. And what asset are you selling today? It's a $10 million deal. Okay. Are you single or married? I'm single. Okay. The first reason why we wouldn't do a DST 1.0 is because what Pierce said, that 5 million per person per year. If you're a married couple, it'd be 10 million, where there's no interest charge for the government for the tax deferral. In other words, if it were like a $12 million deal, that in your married couple, that difference between 10 and 12 is 2. They're going to charge an interest charge on traditional 453 installment sales. So we're going to use a DST 2.0, which is not IRC. It is not IRC 453, and it has no limitation on the dollar amount. In fact, one of the biggest deals was done in San Diego for $100 plus million, which was audited and a successful no change audit. And so there's no interest charge on that. That's the first reason. But number 2, we're now solving for the estate tax, right? Because they have an estate tax problem, which is 40% above and beyond the 24 million married, 12 million single, right? So we always want to clarify, what are we solving for? In fact, I'm working on a deal right now. It is a $160 million sale. It's a business and it's real estate. And he's looking at different strategies. And I'm saying there's only one big domino here. I said, how much of that 160 million is inside your taxable estate? He says, all of it. And I said, what's your plan to get out? Well, I've been told about life insurance. I might, give away to charity. I might try to gift some of it, but I'm like, but that's a lot to try to get out all, what if at the close of escrow, we do it, we just solve that problem for you for the rest of your life. And he's probably, around 50 years old. So he's young, right? He's like,
nice.
And so he's looking at this and I go, I know all of those other people have different, and he has very smart people on his team. I go, but what I'm telling you is the DST 2.0, the DST plus, we're going to solve that big elephant in the room, which is that 40% death tax. The tiger by the tail is just the cap gains tax, which is important. But this DST 2.0, the DST plus, is going to defer cap gains tax, defer income tax, and eliminate estate tax. A little difference here though. When you start receiving payments, you can't stop the payments. Okay. So once you turn the water on, it's just going to flow. Number 2, the payment's going to be based upon your life expectancy. And if you're married, your wife's life expectancy or your spouse. Okay. It's the same cost. Okay. So there's no difference in cost. It is a little more complicated. But essentially it's going to give you that. Now, when you get some of the payments, by the way, it's going to be a mix between cap gains tax and interest. Whereas the Deferred Sales Trust 1.0 is typically just interest-only payments. And so those are some of the nuances. In the DST 1.0, you can also, essentially the note could be amended, meaning it could turn on a payment, and then next year it could turn off the payment. Right. And then it can turn it on, it can adjust it. So we recommend DST 1.0 for deals that are smaller in size, no estate issues, and they have the ability to be very flexible for the client. Right. And their family and their needs. And sometimes that means clients doing 2 trusts. Okay. And they mix a little bit of both. So let's just say it's a $50 million sale. Well, maybe stick to the $160 million sale. First of all, it's 2 brothers. So it'd be 80, right? 80 million. But we might say, hey, let's do 10 million of that 80 into a DST 1.0. And then the other 70 million, let's basically make that for estate tax purposes for your kids. So it's outside the taxable estate. So you get the flexibility of that 10 during your lifetime. The kids still step into the shoes and continue to the DST 1.0, but the DST 2.0 is essentially the legacy billing, right? The legacy of that 40% being eliminated. You follow, Jim?
I do. And then if you do put, say, less than 10 million into the 1.0, but it then doubles at 8% a year for that 10-year note, like we want to do, you're fine keeping it in that 1.0, even if it goes to 19, 20 million.
100%. And if you want it to, it's 10 million basically per year, right? So let's imagine you had a $20 million sale and you're like, Brett, I really just don't want to do the DST 2.0. I just want to do 1.0. Well, could we structure the sale on December 31st, 10 million closes, the calendar year, January 2nd of the next year, another 10 million closes. Okay. So, and you're a married couple. So essentially you got 20 million because you straddle it between 2 years, if we could structure the deal that way.
Okay. That's great. No, that's helpful. I appreciate that.